Good afternoon, ladies and gentlemen. My name is Ryan Souza. I'm one of the senior investment managers here at Sharewise, and we're here this afternoon with Jamie Twiss. Now, Jamie's been kind enough to lend us his time and expertise as he's the CEO of Beforepay Group, listed on the ASX. Now, Jamie's going to give us a brief presentation introducing us to the company and just letting us know how it's going, how it's been performing recently, and then we're going to open the floor up to Q&A. As usual, I've got a couple of questions that will start us off with after the presentation. But participants, if you would like me to ask a specific question to Jamie, please submit it through using the Q&A function on Zoom. Jamie, thank you again for your time this afternoon, mate. It's all yours.
Thank you. It's a pleasure to be here. Thank you for the introduction. So I'll start by, as Ryan said, I'll briefly explain just who we are at Beforepay and what we do. I'll talk a little bit about where the company is at right now, run through some key metrics, give you a sense of the scale of the business and the current performance. I'll then talk a little bit about where to from here. And then after that, of course, we'll go to questions. Please ask anything you like. I love talking about this business, something I'm really passionate about. So looking forward to that conversation. So I'll start with a brief overview of who we are. So we're an Australian listed fintech. So we listed in January of 2022. There are two sides to our business. So the biggest part of our business and where we got started is our consumer-facing business, Beforepay. Now, we were founded very much as a mission-driven business with the goal of giving Australians a safer and more affordable short-term lending product. So historically, one of the most common reasons, in fact, the most common reason people need to borrow is not to go on vacation or to remodel their kitchen. It's just to manage short-term cash flow. So our typical customer is someone who is employed, has roughly the median Australian national income, something in the 60s, but just doesn't have a huge safety net. And so sometimes they'll get their cash flows a bit back to front because often their car is broken down or a sick pet is very common, or it's the holiday season and things get a little bit stretched. They don't want to borrow tens of thousands of dollars for 6 months or 12 months or 3 years. They just want something that'll tide them over until the next time they get paid. And that's our core product. We call it a pay advance. It's a small unsecured loan of about $400 on average. It ranges from $50 to $2,000. The average duration is between 3 and 4 weeks, anywhere between a couple of weeks and 2 months. And we charge a flat fixed fee for that. So we'll charge 5% of the amount advanced. There are no penalty fees, no late fees. The debt doesn't revolve. So if it takes you a bit longer to pay it back, we don't charge you extra. So with complete certainty and transparency, if you borrow $200, that costs you $10, and that's all it's going to cost you. So that's a very consumer-friendly product. Consumers have liked it quite a bit. So we had the commercial launch of that lending business in August of 2020, and it's grown steadily ever since. So that's Beforepay. Then the other part of our business is our enterprise software and analytics business, excuse me, Carrington Labs. Now, this is a newer business. The origin of this business is in order to deliver the Beforepay product in a sustainable way, we had to do two things. One is be highly efficient, and indeed we are highly efficient. So we're currently writing about 40,000 loans a week with a team of about 50 people. And we had to really be on top of the credit risk, the risk that we loan money to somebody who doesn't pay us back, because it is by design a very affordable product. But that means we have to get repaid in order to be sustainable as a business. So we built a lot of capability and a lot of IP around how do you issue loans in a quick and automated way, and then how do you work out who to lend to and how much you should be lending to them. And that IP reached the point where actually some other lenders became interested in, is this something that we, the other lenders, could use for their own businesses? And so Carrington Labs is the business that resells and licenses that software and that risk analytics IP to lenders, primarily outside Australia. So Beforepay, the consumer-facing business, is domestic only inside Australia. Carrington Labs is global, but mostly outside Australia. Those are the two halves of our business. I should emphasize, it is an integrated team. It is an integrated technology stack. Carrington Labs and Beforepay use the same systems, the same technology. We simply take it to market in two different ways. You can see here some of the key features of Beforepay in particular. one thing I didn't mention before is because it is fully automated, it can be very quick. So you can download the app and have cash in your account that we have loaned you, sometimes in as little as 5 minutes if you're more like my daughter when it comes to typing with your thumbs and less like me. 10 minutes pretty comfortably, unless you put the phone down and walk away in the middle. So it is very quick. It is highly automated and highly efficient. Again, with the kind of the number of loans we're doing on a daily and weekly basis and the size of the team, everything has to go through with very, very minimal or usually no intervention whatsoever. The ethical nature of the product has been widely recognized. We've won a number of awards. We've got some of them on the page here. And that's something we're enormously proud of. We are very strongly committed to that mission-driven heritage. While we are a listed company and a for-profit company, we do take those consumer outcomes and that customer well-being extremely seriously. On the Carrington Labs side, so I've talked a little bit about what the product is, which is the ability to support a lender with their own business, with both the loan software, the loan management, as well as that risk analytics and IP. This is a really exciting space, something I'm extremely passionate about personally. I'm a data scientist by training with a long background in building credit risk models. So if you're not careful during the questions and you accidentally ask me something about how this works, you might be here for 6 to 8 hours. I lovingly go through all the details of the risk models and the analytics and how do we do transaction categorization and signal decay curves. I love this stuff. It's come at a really interesting time, obviously. So this is an AI-driven product. And I say that not because AI is a buzzword and everybody says they have AI. We've been doing this since well before AI was cool, but it is the core of what we do. Primarily machine learning with some mixture of non-determinative, generative AI models as well. So that's the Carrington Labs product. If I look at the group overall and how we performed, so we just put out our annual results for FY24. And as you can see, the business really does have scale. So as of June 30th of this year, we had over 240,000 active users. That's someone who's borrowed within the last year. We originated more than $700 million of advances. And again, that's at an average size of less than $400. So that's just under 2 million individual advances that we serviced with this 50-person team. You can see that we are profitable. So we were profitable in every quarter in FY24, reporting a profit of $3.9 million for the year. And that's a very clean, straightforward profit. That's an audited number. And the nice thing about our business, because the loans are pretty short duration, there's very little uncertainty about the risk, about the provisioning. What you see is what you get. So that's a very clean and real number that we're extremely proud of. We're one of the very few consistently, straightforwardly profitable fintechs and startups in Australia. You can see that when I talk about AI-powered risk models, they actually do work. We do know what we're on about. The net default rate, so that's the percentage of loans that don't get repaid, including some that default and then we are able to recover some of that money later, was 1.4%. So we're very, very proud of that performance. I think when we look at others operating in similar spaces, they tend to see numbers much higher than that. And that really is, I think, a testament to all the analytics and the data work that we've done in order to be very, very sharp on who qualifies for a loan and what the size of that loan is. NTM stands for net transaction margin. So that's kind of a gross contribution or a gross profit figure. Or you could think of that as a sort of a revenue less funding costs and defaults and variable costs type figure. Costs are very tightly controlled given the size of the business. They're actually lower than they were last year. We are absolutely ruthless and disciplined on cost. That's one of the reasons our headcount is so low. And I think we really have a virtuous cycle where the commitment to an affordable product means we have to be extremely efficient in how we run things. And that pressure in turn makes us really run a very tight ship. And so we run things on a very automated basis. We fix problems as soon as they crop up because we can't put in place a manual solution for any period of time. And I think that really has made us a much better organization, that focus on being profitable, that focus on controlling costs. Finally, we have a very, very strong balance sheet. As I said earlier, the loan book is well understood. The provision for bad debts is not any great mystery because the debts are short duration. The loan book itself is smaller than many people think because the loans are pretty short duration. And then we've got actually quite a bit of cash. So we have $19 million of cash on the balance sheet as of June 30. We also have additional money in our third-party settlement account. We feel very, very comfortable with the balance sheet. Indeed, we're profitable. We have plenty of resources. We feel we have the risks of our business very tightly under control. We're doing short-term lending, so if things change, we can adjust quite quickly on the fly. I'd say we feel very confident about the future. This slide just gives you a bit more detail about some of the specific numbers. I won't walk through these, but if you're looking to, for example, work out where you think the business is headed, or if you want to build a model of the business, or even just sort of see some of these trends, this will give you a sense of how we've performed over recent full years and half years as well. You can see that we are very disciplined on cost. You can see that operating expenses in the second half of last year were 7.4 million, down from 7.7 the previous half, down from 8.1 the half before that, down from 10.6 the half before that. So we do run a very lean and tight ship, even as we've seen dramatic increases in the number of customers and revenue. You can see more margin and information there as well. All of this is available on our website or in our annual report. These numbers are all drawn from our full year results as well. So if you want to look at them at your leisure, they're readily available. And then a bit more detail on the balance sheet as well. So you can see that as of June 30, we had $50 million in receivables, most of which is the customer loan book. So again, really smaller than sometimes people think, but it also gives us great comfort that the risks in that are very well controlled and maintained. Plenty of cash. You'll notice we have over a year of operating expenses of fully unrestricted cash in the bank. We do finance some of the loan book with an external debt facility. So you can see that we have $50 million in receivables and $36 million in borrowing from the third-party debt facility. I do want to be very clear that debt is purely used to finance receivables. So we have no corporate debt. We have no working capital. There's nothing like that. This is purely, we lend someone $100 and our lenders will advance us up to $80 of that 100. That's the only debt that we have in the business. And then cash flow statement. I won't spend a lot of time on this, but as you can see, we consistently run a pretty strong balance sheet. The actual cash in and out at any given point in time reflects primarily the growth in the loan book versus how do we draw down from our debt facility. But again, when we look at the scale of the movements in cash and we look at the cash that we have available to us, as well as that debt facility, we feel extremely comfortable with where we're at on that cash side. Let me now turn to what comes next. So we have this core business, the pay advance business, that we're very pleased with. I think first and most importantly to me, I am very passionate about the mission. I like what we do for our customers. And if you go online and read our reviews, I always tell people read our 5-star reviews and you will come away feeling really good about who we are and what we do and the role we play in Australia. And then I say, read our 1-star reviews and you will feel very good about the way we prudently manage risk. You'll find the vast majority, in fact, essentially all of the 1-star reviews come from customers who aren't eligible and would like to be eligible or think they should get a larger limit than they do, and so on. So we're very pleased with that core pay advance business and the mission. We're also, of course, I'm very pleased with the performance. I'm delighted to be a profitable company. There's been a lot of hard graft to get there. That comes off the back of being very focused on our unit economics and then very, very focused, even ruthless, you might say, on the cost base of the company. And we've done that successfully. And again, we've put out a number of consecutive profitable quarters, and we feel good about that. Now, I think we have a long ways to go. I think we have a lot of runway and potential in that core product. So we have 240,000 active users. When we look at the size of the market here, we believe that's in the millions. So I think there's much more we can do. We are very cautious and conscious of the cost to acquire a customer. And so the way that we grow through a mixture of organic word of mouth, as well as through some targeted performance marketing, mostly digital marketing, we're very conscious of not overpaying for those customers. We think there's significantly further for that core business to go. We have our operations and our credit risk settings kind of more or less where we want them, but of course we are always looking to improve and optimize that. So in that core pay advance business, I think the path forward is keep growing, and otherwise it's more of the same. That product is working, the business is working, the economics are good. We're pleased with the role that we're playing there. Now, the luxury that we have, and luxury isn't usually a word that I associate with our company because we do run pretty tight and fast. When we first went public in January of 2022, it was when the market was changing quite a bit. And so as a fintech, we had our IPO and there was a significant decline in the share price. We recognized quite quickly that the world had changed. And so while the share price doesn't affect us day to day, we do think about that in terms of capital availability. And so we quickly realized that we couldn't count on the market or anyone else providing any additional capital to the business. So we had to get profitable quickly. We had the money from the IPO, and we were very clear, we're not going to have some big offshore adventure. We're not going to kind of introduce cool new features. We're not going to kind of spend money on things we don't need. I, as the CEO, I unpacked the dishwasher this morning because it was my turn. We're going to grind away to profitability with the resources that we have, with the product that we have. We did that. We actually did it more quickly and with more money left over than we expected to. And so we'd always said our strategy is to get to profitability without making any big changes or new moves. Once we did that, of course, our investors started to say, well, that's great that you're profitable, and what comes next? So what we announced at our half-year results in February were the two initiatives on the bottom. The first one, of course, the second one being Carrington Labs, which I've already spoken about, which is that enterprise software division. We're really pleased with the progress of that, very happy with the pipeline. Since we put out this slide, which is from our annual results, we announced that we signed a partnership with Kiva, which is a multinational lender based out of the US, also a mission-driven lender, which is really nice for us as well. And I think we feel very good about that business. I think the quality of what we're doing is pretty evident. I was in Europe last week presenting at an AI conference talking about what we do. I came away from that feeling that we do have something pretty distinctive there. So we feel good about where Carrington Labs is at and where it's going. The other initiative on this page, personal loans. So we have built a pretty robust platform in terms of how do we originate and service loans, and then how do we manage that risk? How do we do all of that in a fully automated way without human intervention so we can keep operating costs low and be very, very competitive, even aggressive on price? Now, up until the present time, we've been putting all of that through the Pay Advance product. But that capability, that software platform, the IP, the risk models, the AI algorithms sit behind that, that is applicable to many more forms of lending. And indeed, that's what powers Carrington Labs, is the fact that you can take that capability and adapt it to a wide range of products and a wide range of markets. We have always felt that capability is something we could ourselves deploy more widely in Australia. And so we've announced that we are moving into personal loans. So taking a step above the 2-month maximum duration, $2,000 maximum size of the Pay Advance, which is where we cap those things now, and doing something larger and for a longer period of time. I think that's very aligned with the mission. So again, the shorter end of the personal loan market is not especially well served, and the folks who do serve it are often a bit unsavory. And we have a very competitive, very ethical product that I think our customers, I expect they'll be pretty excited about that. So we have announced that we're going to launch a personal loan product. We haven't given very many specifics about that yet, which we will do in due course. But we're pretty excited that will give us a significant booster on growth as well. And we feel we're pretty likely to be successful with that. I think we're pretty good at lending. And I think we know what we're doing. And I think we feel really confident that the skills and the capabilities that we've built for Pay Advance, we can extend those progressively further in a very analytic, risk-aware way. As you can probably tell, we think a lot about cost and risk. So we're excited about that initiative as well. So that's what Beforepay is. That's how we're performing today and where we're going next. We will put out our Q1 results next Tuesday on October 22nd. So if you're interested, I encourage you to watch that webinar as well, and you'll get to see me again. And with that, very happy to take any questions you might have.
Absolutely brilliant, Jamie. Thank you very much for the presentation. And we do have a couple of questions from participants, and I'm just going to kick things off. Now, obviously, you did speak briefly about, AI and the company utilizing AI and being active in the space. Now, when it comes to Carrington Labs specifically as a product, what are you realistically doing with AI in that product? And is it mainly just used, from my understanding, in the assessment of applications, developing risk profiles, or is it much more complex than that?
Yeah, so I'd say it's sophisticated without being complex. I think we try to keep things as simple as we can, but always it's about kind of like thinking very carefully about how we position it and use it. So we use AI in a few different ways. So the way that we build the models for both for Beforepay and through Carrington Labs is we will generate what we call features. So a feature will be a fact about a borrower. So what's your income, or what's your grocery spend, or when we look at your bank transaction data, which is what we base most of our modeling on, do we see gambling transactions, or what's the pattern with which you take cash out of ATMs? There are some patterns that are very innocuous and some patterns that are much less so. So we have a pool of tens of thousands of these candidate features. And what we will then do is we will use AI and machine learning to select usually between 400 and 500 different attributes and train them on the millions of loans that we've done to date, or the client loans, as the case may be, and produce a model that looks at, let's say so we're currently using, let's see, on the 9th generation of the risk model, I think 420 attributes for new users and about 460 attributes for returning users. Because for returning users, we also have a lot of behavioral data of how you've interacted with us in your previous loans. And then those get assembled in a mathematically rigorous way in order to then produce both a risk score, but then more importantly, and I'm sorry, I'm getting a little technical, so I'll stop after this, but we estimate the user's coefficient of default elasticity, which is a fancy way of saying, if we lend you $200, what's the probability we get paid versus $500, and so on for different limits. Yeah. I'll stop there, but as you can tell, if anybody has, sort of 3 free hours this evening, please ring me up and I'll happily talk you through it in more detail.
Gotcha. Okay. All right. Well, appreciate the clarification there. Now, obviously, you just mentioned that you're up to the 9th model, of your risk assessment. Now, realistically, what lessons have you learned when going through actually implementing AI into the business?
Yeah, so this is actually the speech I was giving last week. I was at World Summit AI in Amsterdam, and we're actually one of the few companies that has really deployed AI in the very core of what we do. So a lot of big companies are talking about, oh, we have a chatbot for customer service and it kind of works, or we have a tool to help our employees sort through our confusing policies and try to find the information they need. And that's great, but we actually had put it right at the core of the business. I think some of the lessons we've learned, the first one is you do have to build yourself a very clean technology stack and a clean data environment. I was the chief data officer at Westpac before I was doing this, and I spent a lot of time, just trying to clean up old systems and align different data definitions and wrangle kind of huge amounts of information. That's hard work, but it's absolutely necessary and it pays off. And I think one of the nice things about being a startup is that we've been able to build that from scratch in a greenfield way. I think the other big lesson we've had is that you really need to bring the AI and data scientist types and the commercial credit people. They need to be very closely integrated and really speak common language. I think if you look across big companies, a lot of them will have a very good data science team, but they don't really understand the business. And so they're building models in kind of in their own way in isolation. And the commercial leadership doesn't really understand the data scientists and AI. And so they don't really know how to kind of help them and manage them and give them useful input. And so you kind of have this data science kind of laboratory over here, but it's not actually really kind of like doing the right work in the right way to drive the core of the business.
Okay, so there's a bit of strategic disconnect. Now, obviously, you just mentioned a bit of previous experience at a very large institution of Westpac. Now, realistically, obviously, market cap today is trading around, I think it's 43 million off the top of my head. How do you guys compete with the likes of, major banks and then other, pay advanced lenders, which are going to be many times your size, specifically if you guys are also looking to expand into your personal loans, which again is a very saturated marketplace?
Yeah, so I'd say there are kind of two parts to the answer. The first one is for pay advance and the smaller end of the personal loan market, there's actually very little competition. And the reason for that is if you're a bank, so the average all-in cost to one of our customers of our average loan is less than $20. That's everything they would have to pay under all services, less than $20. And a major bank cannot get out of bed for $20. They can't originate a loan. Just the handling time, the people involved, it's just crazy. They don't even want to do a few $1,000s. It's just not something that's attractive to them. So by being so efficient, so automated, I think we have that space not fully to ourselves, but I would say kind of at the pay advance level, competition isn't what keeps me up at night. I think our ability to deliver that product is all but unique, and I feel confident in our competitive positioning there. And that extends through, really personal loans of less than a couple of years, less than $5,000 to $10,000. That's also not a space where a lot of folks, the oxygen is pretty thin for a lot of folks because they have much higher cost structures than we do.
Okay.
The second piece of the answer, which I think is even more important, is we just understand risk really, really well. And while there are lots of smart people at big banks and non-bank lenders, as I was saying earlier, their ability to actually kind of get to that level of sophistication in how they do decisioning, it's very, very hard it's hard from me culturally, it's hard from a technology standpoint. So if you apply for a loan with a major bank, there's a good chance they'll pull a credit score, and they'll probably pull a couple of pay stubs, and they'll sort of look at it and be like, oh, that looks all right. We're looking at thousands of data points that cover your whole life, and we just understand you 100 times better. And our ability to give you a sharp offer, because we understand your risk so much better, is very effective.
All right. Well, thank you for that clarification. Now, there's a bit of a broader question. Obviously, you mentioned the struggles you guys experienced when you initially IPO'd. Historically, over the past 18 months, smaller caps and micro caps have really struggled in the market. Realistically, what's your view on the state of the market, specifically in the fintech sector at the moment?
Yeah, so I think, I think, there was a period of time, sort of 2020, 2021, when people were fascinated by startups, fascinated by fintechs. There was a great deal of capital available. And I feel very fortunate that we managed to fund the business basically in perpetuity during that time. Then I think after that, there was a period of, you can almost call it panic, where people just didn't want to do anything to do with anything. And you saw, very, very significant sell downs. You saw price reductions. You saw a lot of businesses that expected to be able to access capital, not to be able to do so. And quite a number of them, hit the wall. Quite a number of them are no longer here. And I think we're actually now coming back into a pretty nice place, probably the Goldilocks scenario in the middle, where I think there's a much more realistic view of the market. And I think we're also seeing a lot of I think investors are getting quite much clearer eyed on, some businesses are doing well, have viable business models, are going to make it. And I think they're being rewarded for that. And I think there are others that are kind of really, should they exist, should they not? I think they continue to struggle. But I think we're actually pretty pleased where the market is at present.
Okay, good. All right, well, appreciate the update in that regard. Now, I've got a couple of questions I've come up with during the presentation, and then we'll shift to the participant questions. So sorry for the delay, ladies and gentlemen. Now, you did mention your corporate debt facility that seems to function, seems to fund a fairly large portion of the loans.
Yeah.
Can you tell us who the corporate debt facility with, and obviously, how is that relationship that you guys operate with?
Yeah, so the warehouse, this is all public information that's disclosed in various filings. So we have a facility that's that's funded by two different specialist credit providers, along with credit investors and Balmain Finance. They have a sort of relationship between them in terms of how they fund that. That's a great relationship. So we've been working with Longreach since the first half of 2021. And then as that facility then kind of matured, and we were outgrowing it anyway with the growth of the business. So in order to expand that facility, we also brought Balmain into that relationship as well. So we renewed that facility in October of expanded and extended and expanded that facility in October 2023. It runs for another 3 years. We've got plenty of headroom in it. And it's a great relationship. We get along really well with the team there. I think we're very pleased with that, and they're great to work with. It's an important part of our model.
All right, well, brilliant. Thank you for that one. Now, when it comes to your customer base in particular, and especially growing that customer base, do you see, would you see a lot of this growth coming from, or a lot of the growth and a lot of the sustainability in the company coming from repeat users of the facility, or is it like clients coming in for one-off use and then obviously, never really or not really using you guys again on a regular basis?
Yeah, so good question. The product is designed to be used multiple times and by doing so to replace a revolving credit product. Okay. So one of the ideas behind it, and this is very much kind of at the core of the original mission, is what we see is on average, if you give somebody a credit card, the average credit card holder in Australia has, last time I looked, about $3,000 in debt. And the average interest rate is about 20%. And so they're kind of paying this huge ongoing interest burden and really not getting anything for it, right? So you get that one-time run up to the 3,000, but then that just sits there, potentially in perpetuity. Whereas the way our product is designed to work is when you need that short-term cash flow management, you use the product, you pay the fee, but then you repay it, and you have to fully repay in advance before you can take another one out. So you can't stack them on top of each other. You can't partially default and do another one. So either you always get back to zero, or if you default, we part friends and we won't do business with you again, of course, but unless you repay it. But it's not going to keep sort of spiraling into infinity. So that's we do that because that's a very customer-friendly way of doing it. It protects people. It's the core of that safety. I can probably guarantee you, no matter what happens, you're not going to find yourself kind of like, how did I get into this mess of this product? Which is not the case for revolving credit products. So as a result, what I'd say is customers, once they try the product, they really like it. It's very rare that they go back to whatever they were doing before. And so we do see a very significant portion of our business comes from repeat users as well. Now, if someone only needs it once and they come in and use it and that's that, then of course that's fine as well. And we want our customers to kind of use the product as it suits them, whether that's once or many times or whatever frequency it might be.
All right, well, thank you for that clarification there. Now, one thing I did notice, I'm quickly just going through some of the financial data, is obviously there's been a reduction in operating costs. Now, is there plans to be a further percentage target reduction in operating costs? Are those numbers getting increased due to further capex in Carrington Labs, or what's the kind of plan in that sort of number? Yeah, so we had probably 6 quarters in a row where operating costs came down, and then I would say when we released the results, guys, I think we've hit rock bottom. I think this is as low as it can go. And then I was wrong, 5 times in a row. I think we are now at the bottom. So we've had 3 quarters with essentially the same OpEx. And what we've said to the market in one of our relatively recent releases is we do expect to see costs start to tick up a little bit with the investment in personal loans and investment in Carrington Labs. We're not looking to bet the company on anything. So I think we always think about cost growth and what's the payback for that and how quickly does it pay back. I wouldn't expect the numbers to go down from here, though. I think we are running a very tight ship. I don't think there's a lot of fat that we could be trimming. All right, well, brilliant. Thank you for that update, Jeremy. Now, just the last one for me. Now, obviously with Carrington Labs, it appears to be a product that you're going to sell to other clients, or sell to to other kind of people in a similar space to yourself. Does that inherently take away the edge that you guys present to the market? Yeah, good question. So I'd say that's actually a big part of why we're not as active in Carrington Labs in Australia as we might otherwise be, because we don't want to compete with ourselves. Yeah. We certainly wouldn't offer it to someone with a directly competing product, either in the pay advance or that sort of smaller personal loan space. Yeah. I think we think about it on a case-by-case basis elsewhere. If someone wanted to use this for a mortgage product, we're not terribly close to offering a mortgage product. Yeah. Again, the bulk of our conversations with Carrington Labs are overseas, and we don't have any immediate plans to
actually do direct balance sheet lending ourselves overseas. I think we are pretty happy using Carrington Labs as the primary overseas vehicle, and that's obviously not our core business.
All right, well, thank you for that one. Now, just going to pivot here to a couple of participant questions. Beforepay attained a credit license recently. Is there any risk to the way you conduct credit assessment in the Pay Advance product, in the way in that you may be asked to have more human input in the process?
Yeah, sorry, could you just read the second half of the question? I heard the first half, but is there any risk to the way
the second half is there any risk to the way you conduct credit assessment in the Pay Advance product, in that you may be asked to have more human input in that process?
Great question. So there are a number of additional obligations that come with having a credit license. When it comes to the upfront risk assessment of somebody, the main one is, I mean, you have to have reasonable inquiries and a number of other things that I would say we already do. You also have to fill what are called responsible lending obligations, which are understanding the customer's financial position, asking them some additional questions. And we will, of course, do all of that. And that kind of core idea and value of responsibility is obviously very deeply embedded in who we are already. So we have to make we have to do a few additional steps. To the best of our knowledge, we're going to be able to fully automate all of those steps in due course, and we don't expect that the way we do things will look vastly different in the future. I'd also say it might not look that terribly different at all, again, because the current way we do this is really good, right? And we get a pretty sharp point of view. There are no that I'm aware of any legal or regulatory requirements around sort of specifically having a human look at something and kind of say that looks good and push the green button. The other thing I say is the Pay Advance product still operates under the same exemption from the Credit Act that it does today. So we don't expect that there will be significant changes to that product at all, unless we want to make them, of course. So we don't see a big risk there.
Okay, all right, well, thank you for that one. Now, moving on, in some of the early discussions with potential clients of Carrington Labs, what do you envisage as the sales and then implementation process? Do you envisage working with established lenders or new entrants?
Yeah, so we're still at the stage where we're going quite broadly out to the market and talking to all sorts of different people. I think with new entrants, we would like clients that have sort of meaningful scale and can provide a meaningful amount of revenue in exchange for the effort to kind of bring them on board and train them models and so on. And so while I think we would do sort of a newer company that had kind of real volume and scale, I think it would be less likely we do like a really scrappy startup just because they tend to be smaller and not very well resourced. So I think we're more likely to do most of our work with more established lenders, but never say never. It'll depend a bit on just what opportunities we continue to see.
All right, well, thank you for that. Now, on this topic as well, a participant asked, who are some of the ideal customers for the Carrington Labs products/models? I presume this question would probably more be targeted at what sort of financial instruments?
At what?
What type of financial instruments?
Yes. Sorry, I should have said that. So it is very much for lenders who are looking to make loan decisions and limit setting decisions. And those could be banks or they could be non-bank lenders, either one, or indeed companies that are entirely different but want to have some sort of lending capability. Some merchants that will self-finance things. That's particularly common in emerging markets. I'd say right now, so we've said publicly that our priority market is the United States. And I think if you tier the United States lending market into 3 tiers, big, middle, and small, there is a point at which small becomes too small.
Yeah.
Medium is very attractive for us. So you have lenders, credit unions, banks, non-bank lenders who are looking to stay competitive, who would like to take advantage of cutting edge data science and AI, probably don't have the resources or expertise to do that internally, but are willing to kind of try new things and work with someone like us. So that's a very attractive place for us. At the very big end of town, I think that's potentially attractive as well. Those are big companies that move on a different time frame. So I'd be pleasantly surprised if a really, really big US bank was the next announcement we made, just because they tend to have longer sales cycles.
Yeah, okay. Well, just one last one to finish this off. Participant asks, you say a flat 5% rate. Does this have a time limit? What is the incentive to pay promptly? Hypothetically, I need $1,000 today to get my car back from the garage and I don't get paid till next week. Why should I pay next week or next month if the flat rate is only $50 regardless of the time involved in borrowing the money?
Yeah, great question. And this comes really to the kind of heart of what we do and how we do it. So in terms of duration, we actually, with a bit of input from you, but we set that duration for you. Okay. So it's not the case that you borrow $1,000 and you pay it back whenever you feel like. One of the things we do, so when you onboard with us as a customer, we will get your consent to take a copy of your bank transactions, which we do in an automated way. And one of the many things we do with that information is we work out how much you get paid when. So we'll look at you and say, okay, this person gets, sort of $2,200 every other Thursday. And then when we've worked out what the appropriate limit for you is, we will present you sometimes with a few options, sometimes only with one, but with a repayment schedule that lines up with that. So if we might say, okay, you're borrowing $300, we can either come for that in 12 days time when you next get paid, or we can come for half of it in 12 days and half of it a fortnight later. But those will be your two choices. Yep. And then we will then debit your account on those days, get the money back. Now, if you really, really, really want to not pay, you can do all sorts of things. You can move the money around. And so one of the things we look for, we also do a lot of behavioral modeling as part of that risk model to understand, well, are you the sort of person who might try to kind of, duck and weave around this? And we've gotten pretty good at spotting that. So we generally find ways to primarily advance money to people who are going to say, yes, you borrowed, I borrowed the money, I'm going to pay it back. We make that easy by setting up that schedule and debiting them on the day they get paid.
All right, brilliant. Well, thank you for that one, Jamie. That about finishes us off, mate. Is there anything you'd like to leave us with?
No, I just think, as you can probably see, I'm really passionate about this business. I love the mission. I'm really passionate about what we're doing for our customers and the role that we play in Australia. And as you can probably also tell, I really, really love the risk and the analytics. And I think that ability to really understand our customers in a quick, easy, efficient digital way that we can do quickly and cheaply, but then really gives us a sharp point of view on them in a way traditional lending methods don't. I think that's a fantastic asset of the business. And I think we've got a lot of different places we can take that, both in Australia and globally as well. So given the business is performing well, we're profitable, we're well resourced, we have plenty of cash, I think we feel pretty optimistic about the future.
All right, absolutely brilliant, Jamie. Thank you very much for your time and expertise this afternoon. Really appreciate it. Ladies and gentlemen, thank you very much for joining in. Obviously, this one will be trimmed up and then chucked up on our YouTube channel. So feel free to watch or send through any further questions to Jamie. Appreciate your time. Enjoy the rest of your day. Cheers.
Thank you, everybody.